All right, so a key cornerstone to anticipating big moves, days, weeks, months in advance, hinges down to your map of the markets. And a large part of that is essentially your ability to identify key turning points or key levels, okay? Key levels in the market are of no coincidence. They essentially represent where banks, institutions, the bigger players in the market have had or could potentially continue to have orders, all right? And this is something we want to have in our arsenal. Horizontal levels are very important. They have memory, and certainly in range-bound markets where we have multi-highs and lows, they're very important to us, and we can really get into a big potential move very early on without having to wait for all these confirmations. Because sometimes, if you're a price action based trader, for example, if you trade bearish or bullish pin bar reversals, sometimes when the market gets to a key level, the market will just move off the level without a care in the world, and it will leave you behind. Okay, so this is why market mapping is very important. And in this webinar, I'm going to talk to you about what a market map is, why we do it, and how we do it. Okay, so it's going to be very hands-on, and we're going to apply it to the market today. I know we've got some examples in the presentation, but there's no substitute for the current market. I mean, you know, it's real-time learning. It's very easy to pick picture-perfect examples from the past, but as I said, we want to apply it to the present. Okay, so what is a market map? It's essentially a chart, could be of anything. It could be a currency pair, stock of any indice. It could be a UK, US stock on the DAX, the CAC, Germany and France, respectively. It could be a commodity. But essentially, regardless of what it is, it's a process whereby we are able to analyze or identify key levels of support or resistance on the monthly, weekly, and daily time frame. Okay, and this is something which we like to do. We like to start at the higher time frames, for example the monthly, and then churn down to the weekly and then the daily, because it's fair enough to say that market structure is deeply embedded. Certainly the higher the time frame, the stronger it's likely to be. Okay, so this is what we are doing when we're drawing a market map. The higher time frames have bigger governing power over the smaller time frames. This is why I personally trade the daily and the weekly, purely because if it's a trending market, there's strength in a trend. If it's a range-bound market, there's strength in the range. If it's anything smaller than like the hourly, for example, you're susceptible to intraday spikes, unexplained news announcements, or just horrible noise in the market, which can really cost us a lot of money if we're scalping, dare I say. All right, so essential to take advantage, or not to even take advantage, but identify key levels of support or resistance on the weekly and monthly, because once we've got those levels in, all we need to do is wait for the market to come to us. That's the beauty of it. And this is true in so many different aspects of life. Waiting for the opportunity to come to us once you've got our plan. Any of you who've read The Art of War by Sun Tzu, the war is won before it's begun as a result of meticulous planning from the outset. All right, so not only are we drawing a market map here, thanks to the monthly, weekly, and daily, we're also identifying market structure and a level of predictability within the chaos and randomness where anything can happen at any time. Of course, we can get it wrong sometimes, but as technical traders, we go with the probabilities, even in the face of adversity sometime. The market is called a market for a reason, and there's nothing more tedious than we've got a decent trade idea based on, say for example, shorting the FTSE at a multi-year high, say last year. I know it's not a currency pair, but it doesn't matter. It's just an example. And you're always going to get someone saying, well, the FTSE is going up. It's going to breach 7,000. Well, you know, it might do that, but, you know, who knows for sure? Okay, so this is why we always pick high reward to risk setups off the back of this. Okay, so when we're right, we can be proven very right and potentially be rewarded very handsomely for it. If we're wrong, we only lose a small amount. Okay, so we embrace the positives and the negatives through risk management. Okay, so why do we draw a market map? Well, I'm pretty sure I've covered this already, but repetition, I found through mentoring is the key to success. So I'll tell you again, I guess. We can essentially identify key turning points in the market way in advance of the market reaching them. So we're looking at the monthly, a very strong level of support or resistance, which is formed over the course of 5 years, 10 years, even 20 years. For example, Aussie New Zealand, which is something I'm going to show to you when you get to the actual charts, the live charts. People who essentially draw the market map and identify the 25-year level of support would have done very well last year if we're just simply buying at this this multi-year low, a level which hasn't been breached for 25 years. Okay, so another advantage to pre-planning levels of support and resistance from the outset is so that you can identify the price coming to you beforehand so that your vision or your perception is not clouded, and you can just make an informed decision as of when the market gets to your level in advance. Okay, so set and forget trading. Those of us who trade the weekly and the daily, we have the blessing of knowing what to do days, weeks, even months in advance of the market getting there. And this is what I call a well-executed plan. Rather than being in the heat of the moment and turning on your computer and thinking, looking at the hourly chart, oh goodness, there's a trade set up there. You trade it and then you think, oh God, I didn't see this level of resistance in the way. Damn. I'm sure a number of you have been there. I certainly have. So it's all good. We learn from our mistakes. Sometimes some of you decide to do it the hard way. I certainly did. But then I eventually decided to get educated about it. Okay, so in order to do this, as I'm sure all of you have probably deduced by now, what we want to do is we want to look at the daily, weekly, and monthly. And we want to identify both hard and soft levels of support and resistance. It's best, I know a number of you might wonder, okay, which way do you start? I would say start on the monthly, draw your levels of support and resistance on the monthly, then the weekly, and then the daily time frame. Because what you have the advantage of doing then is simply drawing the level on the monthly, and then once you get down to the weekly, you'll see that the level's already drawn there, so the work's already been done for you. And when you go down to the daily, you'll find levels which you might not even see on the weekly or the monthly. Okay, so that's the beauty of it. So here we go. This is a pound CAD on the monthly. We can see it ever since 1994. Can you remember what you were doing then? Well, the market has memory, and we can see that since 2005 we've been trending downwards on the monthly time frame. But certainly from 2010 and 2012, which this chart was taken from, we can see that we've been consolidating. And as we're in a general downward trend here, it will be safe to say that we've got a key level of monthly resistance and support here. Let's go down to weekly. And when we get down to the weekly, we can see levels which we wouldn't have seen on the monthly. So there we go. And some of you more astute people who pay more attention to the detail will, and I hope you do this, essentially draw the levels of different time frames in different colors. So the monthly level, just for example's sake here, I've colored orange, the weekly level blue, and as you'll come to see when we get down to the daily, I've colored it in black. Okay, so you've got a real kind of like measure of perspective there. Okay, so orange is the stronger level, being the monthly, the weekly is the second strongest, being the blue, and the daily being relatively strong, not as strong as the weekly or the monthly, being black. All right, and you can see that in this well-established range here, I mean, you don't really have to be a rocket scientist to deduce that if price does come down to this horizontal level here, this monthly level of support, that it's likely, based on what price has done before, that it's going to go up again. But had we not had this level drawn in a nice, bright, obvious-looking color, then it's likely that certainly when people are getting carried away with the smaller time frames, which is something a lot of people do when they're new to trading, that they wouldn't have spotted it. And they might have decided to have taken a short on the hourly if the market comes down to here, only to their horror to realize that there's a huge level of monthly support in the way. And this is something a lot of intraday traders get wrong. Okay, they place their trades in the way of key levels of support and resistance, essentially the market map on the monthly, weekly, and daily levels. Okay, so just to give you another example, we've got well, sorry, we moved on to another example, but you can see here on the monthly, weekly, and daily, anything above the price is a potential sell level, like here. This is the potential sell level on the daily time frame. Then we've got the potential sell level on the weekly, and then a potential sell level on the monthly here. Anything below the price is a potential buy level. And of course, as we deduced with looking across the monthly, weekly, and daily time frame, we've got ascending strength in the levels of support here. So obviously, price does come down to this level. I'd far rather get long on this monthly level of support than certainly the daily. The harder time frame, the stronger it is, especially in a range-bound market. And this is absolutely fantastic in order to get. And you know, pound CAD, I know it's gone a long way since then, but there are certainly other range-bound markets I'm going to draw your attention to. Let's move on. Here's another example. Here we go. So Euro New Zealand, we can see here that on the monthly, we've drawn our monthly levels in. I know they span back all the way back to 2000. You know, that's quite a long way away, but it doesn't matter. Levels have memory. That's the key factor, which a lot of people are very happy to forget here. And then we go down to the weekly. We can see here we've got downward trending markets, ascending wedge, and we can put our levels of support and resistance, horizontals, as well as trend lines.